Passive and active investing are two distinct types of approaches when it comes to managing your investment portfolios. They differ in terms of strategy, philosophy, and levels of involvement. So let's look into the key differences between active and passive investing. Let's start off with the investment strategy. For passive investing, this strategy involves constructing a portfolio to replicate the performance of a specific market index, such as the S&P 500. Passive investors believe it's challenging to consistently outperform the market over a long period of time. Common passive investment vehicles include index funds and ETFs. With active investing, the aim is to outperform the market by making strategic investment decisions based on research, analysis, and market forecasts. They often buy and sell securities actively, attempting to identify mispriced assets or take advantage of market trends. Now let's look at management style. Passive strategies involve minimal buying and selling of securities. The portfolio is designed to mirror the performance of a specific benchmark, and adjustments are only made to maintain that alignment. This approach overall tends to have a lower turnover. On the other hand, active investors frequently buy and sell securities based on their analysis and predictions. The management style is more hands-on, involving ongoing research, monitoring of market conditions, and active decision-making to adjust the portfolio. Now a big one, costs. Passive strategies generally have lower costs because they involve less frequent trading and typically use low-cost index funds or ETFs. Transaction costs and management funds are usually lower than typical active strategies. Active strategies can be associated with higher costs due to the more frequent trading, research expenses, and higher management fees charged by actively managed funds. These costs can erode returns, especially if the fund doesn't outperform the market. Up next, performance expectations. The goal of passive investing is to match the performance of a specific market index. Therefore, they expect their returns to be in line with the overall market, as they're not trying to beat the market. However, this is not the case for active investors, as they're trying to beat the market. The success of an active strategy depends on the skill of the fund manager or individual investor in making better investment decisions than the overall market. Lastly, time and effort. Passive investing typically requires less time and effort as it adopts a set and forget approach. Investors can achieve a broad market exposure with minimal involvement. Active investing, however, requires more time for analysis, research, and consistent decision making. Overall, active investors need to stay on top of market trends and adjust their portfolios accordingly. It's more important to note that active investing involves a high level of research, analysis, and monitoring compared to passive investing. Additionally, active investing carries both the potential for higher returns and higher risks, and success often depends on the investor's skill, discipline, and ability to make well-informed decisions. Ultimately, the choice between active and passive investing depends on an investor's goals. Some investors may choose a combination of both strategies. This is known as a core and satellite approach, which best aims to balance the benefits of passive and active investing. XTB's investment plans aim to help both active and passive investors. Download the XTB app in the App Store to start investing in ETFs with XTB's investment plan.